Very good morning, everyone. Everyone. Now, first, let me know that whether my voice is audible or not. Everyone, respond fast so that we can start once again the discussion on expected question of financial instrument chapter. Last day, we have done the discussion on the same chapter, but we have taken the question related to financial asset, financial liability, and compound financial instrument. Now, today we'll take the balance question of this chapter, which are expected from my point of view. Got it? Audible? It's this. My voice is audible, everyone? Can we start? Okay. So we'll start with the question number 2 of the expected question, because question number 1 already we have done in the last video. Okay, yes sir. Question number 2, good question. What they have given, let's see. Blueberry Limited entered into following transaction during the year ended 31st March 2002. Entered into a speculative interest rate option. Speculative interest rate option means it is a derivative instrument. Now whenever speculative, it means it is held for the purpose of trading. Whenever there is a derivative instrument which is held for the purpose of trading, initial recognition will be done at fair value, correct? And subsequent recognition will be also done at fair value, means it will be recognized initially and subsequently measured at FBTPL, correct? Means any fair value gain or loss will be transferred to PL. So you can see they have purchased at 10,000, so initial recognition will be done at 10,000, correct? So costing rupees 10,000 on 1st April 2000 to borrow rupees 60 lakh from Exxon Bank commencing on 30th June 2002 for 6 months at 4%. So this is interest rate swap. So can you see this information, that what is the amount of loan, what is the rate of interest, that is not at all important. This is interest rate swap, means it is one type, I will say it is a imaginary loan, means loan, the contract is for loan but actually the loan has not been taken. Now if the interest rate increases or decreases, based on that the fair value of derivative will increase or decrease. Understood? So initially when you have entered into interest rate swap, you need to pay how much? 10,000. So you need to recognize a derivative financial asset at fair value, that is 10,000. Understood? The value of option now on 31st March 2002 become 15,250. It means there is a gain of 5250 because the fair value increases. The fair value increases to 15,250. The gain is 5250, that will be transferred to PL. So you can see what journal entry they have given. Check karenge everyone. So you can see what journal entry they have done for this. So initial measurement financial asset, or you can add on derivative financial asset, to cash or bank 10,000. Then subsequent recognition on reporting date, what journal entry you will do? Financial asset to fair value gain, and the fair value gain will be transferred to PL, that is 5250. Understood? Correct? Yes sir. Then what about second transaction? This was the first transaction. Now this is the second transaction. Purchase 6% debenture in Fox Limited on 1st April 2001, the issue date, for rupees 1,50,000 as an investment. Blueberry Limited intend to hold the debenture until the redemption at a premium in 5-year time. The effective rate of interest of the bond is 8%. So can you see, because this will be hold to collect cash flow till maturity, therefore it will be measured at amortized cost by applying EIR, correct? It means initial journal entry will be investment account debit to bank at rupees 1,50,000. Then subsequent recognition will be done at amortized cost by applying EIR. So you can see the contractual rate of interest 6% and EIR is equal to 8%, means you recognize interest income by applying 8%, not 6%. Correct? Yes sir. So what journal entry they have done? Check karenge. First for debenture, investment account debit to bank means financial asset account debit to bank 1,50,000. Then we recognize interest income on such financial asset by applying EIR. So what journal entry? Journal entry will be financial asset to interest income. So you can see financial asset account debit to interest income at 8%, 12,000. But can I say we receive some contractual payment for interest at a rate of 6%? So how much whatever amount we receive, journal entry bank account debit to financial asset. So bank account debit to financial asset at 6% contractual rate of interest, that is 9,000. Correct. It means can I, this plus this minus this will be the amortized cost that will come in the balance sheet. So what will be the amount to be shown in the balance sheet will be 1,50,000 plus 12,000 minus 9,000. So 1,53,000 is the amortized cost to be shown in the balance sheet, in the asset side of the balance sheet. Chalega? Yes, sir. So second transaction also you have understood. Let us come to third transaction. Purchase 50,000 shares in Cox Limited on 1st October 2002 for rupees 3.5 each as an investment. The share price on 31st March now become 3.75. Now this is investment in equity shares of any company. So investment in equity share, if it is held for the purpose of trading, then it will be classified as FBTPL. Otherwise an option has been given. An option has been given that it can be also measured FBTOCI without recycling, but that option is given, and entity may also opt for FBTPL. Means if it is not held for the purpose of trading, entity may either opt for FBTOCI or FBTPL. If it is FBTOCI, it will be without recycling. I hope you remember. So what is given? Let's see. So the accounting treatment and the relevant extract from the financial statement for the year ended 31st March 2002 of the transaction related to financial instrument. Blueberry Limited designate the financial asset at FBTPL only when this is unavoidable. Means what they are saying, they will designate any financial asset FBTPL only when it is unavoidable. Means when you cannot designate as FB, means when you need to designate only as what FBTPL, otherwise it can be designated what in some other category also. So can I say for this it is understood we need to apply FBTOCI na. I hope you have understood. This will be without recycling. The first journal entry will be investment account debit to bank, means financial asset account debit bank at rupees 3.5, that is 50,000 into 3.5. How much? 50,000 into 3.5 is equal to 1,75,000. Now the price from 3.5 become 3.75. So there is a gain of how much? 50,000 into, it is what, 0.25. So the gain of 12,500. This gain will be transferred to OCI and accumulated in a separate component of equity. So journal entry will be financial asset to what? To OCI, and you can transfer it to FBOCI reserve. Understood? Let's see what journal entry they have done. You can see financial asset account debit to cash or bank 1,75,000, and then subsequent journal entry financial asset to other equity, and this will be through OCI. Correct? 12,500. This other equity you can give a name FBOCI reserve. This name also you can use for the reserve where it will be transferred. Got it? So can you see the balance sheet? In the balance sheet, the asset will now become 1,75,000 plus 12,500, that it is at 1,87,500. So in balance sheet, can I say we need to now disclose all the asset. You can see we have three assets. One is interest rate option financial asset, one is investment in 6% debenture in Fox Limited, one is investment in shares in Cox Limited, and these are what closing balance of these. Correct? Now just try to understand, whatever financial asset which are held for the purpose of trading, it will be always current asset. So you can just write down that this financial asset will come under current asset. Now whatever 6% debenture, can I say, because it is amortized cost, some portion may be current, some portion may be what non-current, depending upon what amount is receivable when. So you can find out how much is what receivable within 1 year and how much can be receivable after 1 year. You can calculate that. So some portion will be current asset and some portion will be non-current asset. You can disclose in that way also. And shares in Cox Limited, because it is not held for the purpose of trading. It is not held for the purpose of trading because we have classified such financial asset at FBTOCI. It means it is not held for the purpose of trading. So we can say it is a non-current asset. we can say it is non-current asset. Understood? Yes sir. Now how much portion will be, means for this how much portion will be current and how much portion will be non-current, what we can do, we can prepare what, one amortization cost table. Means you can do in this way, year 1 year 2. So opening balance was how much, it was year 1, means I'm just informing you how to calculate, it was 1,50,000. So 1,50,000, correct. Then interest income at the rate of 8%. So 1,50,000 into 8%, it is coming 12,000. Correct. Then contractual cash inflow, that is you have taken 6%. So that is how much, 1,50,000 into 6%, that is 9,000. So we'll do this plus this minus. So it is 1,50,000 plus 12,000 minus 1,50,000 plus 12,000 minus 9,000 is equal to what, 1,50,000. This is the opening balance, this is the closing balance of first year, means opening balance of second year. This will be 1,53,000. Correct. 1,50,000, 1 second, 12%. So it is coming 18,360. And this will remain 9,000 only. Correct. So minus 9,000, how much? 1,62,360. Correct. Have you understood? Means one thing is clear, that whatever we need to pay, in the second year, that is entirely related to interest amount only. Means can I say whenever this amount is increasing, it means can I say nothing is payable within 12 months, means entire become non-current asset. So this 1,53,000 will be entirely non-current asset, So you can add on this, there is no current asset portion, entirely will be what, non-current asset portion. So that is what I will say, this is the better presentation. If they ask extract a balance sheet, so these two will come in under non-current asset and this will come in the current asset. Understood this point? Have you understood? Now in SOPL, can I say in SOPL we write down what, interest income. Interest income is what, 12,000 interest income on debenture, and there is one fair value gain. There is fair value gain, what is 5250, that is what will be transferred to PL, and there is one fair value gain which will be transferred to OCI. So after this you can also write down how much will be transferred to OCI. OCI may how much it will be transferred. So that gain is how much, you can see 9, how much gain, fair value gain 12,500. So this 12,500 will be transferred to OCI. So these two will be transferred to PL and this will be transferred to OCI. Got it? So this become what, extract of SOPL. Understood? So I have given the better presentation as per ICAI solution. ICAI solution has only given what will come in the asset side, but whether it will be current asset, non-current asset, that is not given. Understood? Yes sir. Question number 2 you have understood. Now let us come to question number 3. Now question number 3 is related to embedded derivative. Now whenever there is a embedded derivative and any derivative is embedded in a host contract, normally we need to separate the derivative from that host contract. Understood? Now how to separate, that we are discussing from this particular question. Let us do. You can see D Limited issued callable preference shares. You can see call option, callable preference shares. Call option is inserted in preference shares. So this call option is what, embedded derivative. Now call option means what, right to buy. So right to buy will be with what, entity. So this is call option is nothing but right to buy, means right to repurchase. Now will be held by whom? Will be held by entity, or we can say the entity who has issued such instrument. Correct. Preference share to G Limited for a consideration of 10 lakh. The holder has an option to convert these preference shares to a fixed number of equity instrument of the issuer at any time up to a period of 3 years. So they have an option to convert. So it means it is a optionally convertible preference shares. Now optionally convertible preference shares is a compound financial instrument in which call option is inserted. Means call option is inserted in optionally convertible preference shares. Correct? If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. If nothing is given, we'll always assume redeemable at par. The preference share carry coupon of RBI base rate plus 1%. So can you see this become contractual rate of interest? This become contractual rate of interest. The prevailing market rate of similar preference shares without conversion features or issue a redemption option. Issue a redemption option means right to buy. So without call option, without conversion option is RBI base rate plus 4%. So can you say this become market rate of interest? Market rate of interest. On the date of contract, RBI base rate is 9% per annum. The value of call is determined using Black and Scholes model for an option pricing, that is 29165. So what they have given? They have given fair value of call option on contract date only. Correct? Thank you very much. And they have given RBI base rate 9%. One thing is clear, that contractual rate of interest will be 10% and market rate of interest will be 9% plus 4%, that is 13%. Correct? Calculate the value of liability and equity component. This is given. Correct? We just try to understand what happened in this contract. This is question number 3 we are doing. So in this contract, this is entity who has issued a optionally convertible preference shares. Correct? This is entity and this is the holder of this instrument. Optionally, first I am just saying optionally convertible preference shares. So can you say for optionally convertible preference shares, some amount will be received from entity? Correct? I hope you have understood. Correct. So this is one contract. This is known as host contract. We call it host contract. So some amount is collected, means some amount is received, some amount will receive from holder to the entity. Now what happened? There is one option also. There is another contract which is call option. Now call option will be held by whom? So it is held by entity because they have a right to repurchase. It means some consideration will be paid by entity to what? This preference shareholder. This is preference shareholders, na? Entity to preference shareholders. Means for host contract some amount will be received, but for call option some amount will be paid to preference shareholders. Means can I say this amount minus this amount will be equal to the proceed received. So what is the total proceed received in this contract? In this contract it is 10 lakh. Means can I say in this way? If I apply one equation, the equation will be equal to proceeds will be equal to fair value of optionally convertible preference shares minus what? Fair value of call option, minus fair value of call options. I hope you have understood. Correct? This point have you understood? Correct. Now proceed is equal to how much? 10 lakh. Can I say this is not given? Fair value of optionally convertible preference shares is not given, but fair value of what? Call option has been given. That is how much? This is given 29,165. It become 29,165. It means can I say what is the fair value of optionally convertible preference shares? That is equal to 10 lakh 29,165. So that become 10 lakh 29,165. This have you understood? Have you understood this part? Now can I say this? If you have understood this is nothing but a compound finance instrument. Now out of these, some portion will be what? Fair value of liability component. And balance will be what? Balance will be fair value of equity component. Balance will be equal to fair value of equity component. Now you know how to calculate fair value of liability component, that we can find out. So that we can calculate. So we'll do year end contractual cash outflow, present value factor by using market rate of interest, that is what? 13% given in the question, and then we can calculate present value. correct. So this is for how many terms, check करेंगे how many year it was issued on which date, means it is for 3 years, means for 3 year we need to do discounting, correct, yes sir. So year 1 and 1 2 and 3, contractual cash outflow will be calculated by using contractual rate of interest, that is 10%. So 10% of 10 lakh, 1 lakh, 1 lakh, 1 lakh and 1 lakh. Can you say at the end of the year we need to also consider principal value? What is the redemption value for principal portion? Correct now, because it is given optionally convertible. So can you say initially the principal amount will be considered as financial liability, and is given that option is that either you can convert or redeem at par, means it will be 10 lakh. It will be 10 lakh now. Now we can find out present value. We can easily find out present value. Correct. This amount I am taking from the solution only. I am not calculating. The amount is given. How much they are given? This is what? Principal payable. This is interest payable. The total become how much? Check करेंगे. It is 6,93,050 plus 2,36,115. That is equal to 9 lakh. The total is coming how much? Once again I will calculate. 6,93,050 plus 2,36,115 is equal to 9,29,165. It is coming 9,29,165. So balance portion will what? Balance portion will be fair value equity component, that is 10,29,165 minus 9,29,165. The value of equity component will be equal to 1 lakh. Will be equal to 1 lakh. Have you understood this? Cool. Simple. Now you can present it properly. First find out this, then apply the equation. Got it now? Have you understood this point? Cool. This is expected from my point. This question is expected from my point of view. Done? Got it? Yes sir. Can we come to one more question? 3 also we have done. Correct. 4 I will do at the end. 4 I will come back again. I am taking first derivative all questions. 5 already we have done. 5 we have done. 6 already we have done. 7 already we have done. 8 also we have done. 9. Come to question 9. This question is also expected and can be asked in exam. Chalega? Yes sir. On 1st Jan 2001, same company limited agreed to purchase $20,000 from Jetty Bank in future on 31st December 2001 for a rate equal to 68 per US dollar. So can I say it is a forward contract to buy US dollar in future at rupees 68 per US dollar. Same company limited did not pay any amount upon entering into contract. Whenever in derivative no amount is paid, it means it is a future contract. When some amount is paid, means if the amount of premium is paid, then it is an option. Correct. Either it can be future or it can be option. Same company limited is listed company in India and prepares financial statement on quarterly basis. Whenever they say they are preparing on quarterly basis, it means what? We need to do subsequent recognition at each quarter end. At each quarter end, because we are preparing interim financial report. Correct? Yes sir. Following the principal recognition measurement as laid down in Ind AS 109, you are required to record the entry for each quarter ended till the date of actual purchase. Actual purchase means what? Can you say on settlement date, they can be either net, either this derivative can be net settled in cash or by actual delivery of what? Dollar. So when they say actual purchase, means that will be settled physically. Physically, na, it means it is a physical settlement. Correct? Yes sir. For the purpose of accounting, please use the following information representing mark to market fair value of forward contract. So they have given fair value of forward contract at the end of each year. Whenever they keep negative fair value, it means there is an obligation to pay. So it becomes liability. So this is liability, this is liability. Then positive means it become asset. Correct. Spot rate on 31st December 2001 is 66 per US dollar. Correct. So let me explain you this question first. So they have given question number. We are doing question number. Which question? Question number 9. Question number 9. You can see there are 4 quarter. 4 quarter. Correct. So we have entered into a forward contract to buy 20,000 US dollar at rupees what? 68 per US dollar, at rupees 68 per US dollar. Correct. So it is a derivative contract which is not held for the purpose of hedging. If it is held for the purpose of hedging, then we need to apply hedge accounting. But if it is not held for the purpose of trading, if it is not held for the purpose of hedging, means it is held for the purpose of trading. Correct. So we need to find out a fair value of forward contract. So initially it is nil. Already I have given the expected question of May 2023. I am discussing that only na. अरे भाई I am discussing that Rohit. Already I have released the expected questions. Correct? And you can download from the link of that expected question is given in the description of this video. You can download it. Correct now? And that only I am discussing. I am discussing the expected questions only in this video. Chalega? Okay. So initially the fair value is nil. Why it is nil? Because no consideration has been paid to enter into such contract. Then it become how much? It is given how much? 25,000 liability. Then it become 25,000 negative. Then it become how much? It become I think 15,000. 15,000 negative. Then it become what? 12,000 positive. And on this date, the spot rate becomes 66. Correct. Now you have entered into contract to buy at 68, but the spot rate is 66, means it is unfavorable situation. Unfavorable situation. So you can see 68 minus 66. So there is a what? Loss of 2. So overall there is a loss of 2. It means fair value of the contract on settlement date is negative 2 into 20,000. Means the fair value become negative 40,000 on this date. Negative 40,000 on this date. Understood why it is unfavorable? It is unfavorable because you have agreed to pay 68, but now the price per dollar becomes 66. So in the market the price is 66, but you need to pay how much? 68. It means it is unfavorable situation for you. Got it? Understood this point? Now this is a fair value. This is not gain or loss. Normally students think that this is a gain or loss. This is a fair value of forward contract, and even though it is very simple question, student, if they are conceptually not clear, they may do mistake. So this is not gain or loss. If negative is given, it does not mean loss. It is a fair value of the forward contract, and there is an obligation to pay. Means it can be either liability or it can be either asset. Correct now. So loss means what? This is loss. So from 0, if it become negative 25,000, the loss is 25,000. In the second quarter, you can see liability decreases. It means there is a gain of what? 10,000. There is a gain of 10,000. Correct. And in the third quarter, you can see liability become asset. So there is a gain of what? 15 plus 12. If negative become positive, so we need to what? Negative become positive. So 15 plus 12 हो गया ना? It is 15 plus 12 how much? 27,000 gain. And then asset become what? Liability. Once again we need to add it, but there is a loss. Loss of how much? 52,000. Have you understood this point? If you can understand this is very simple question. So question number 9 we are doing. We will start from the first date. The first date is 1st Jan 2001. So on 1st Jan 2001, on 1st Jan 2001, can you see because fair value is nil, so no journal entry. That is no journal entry as the consideration paid to enter into the contract is nil. Okay. Then second journal entry will be on 31st March 2001. What journal entry? There is a loss. We will pass journal entry fair value loss account debit, which will be transferred to PL to what? Derivative financial liability. Derivative financial liability, you can add on simply financial liability. Correct? I am writing derivative to inform you that yes, this is a derivative topic. Correct? The loss is 25,000 and liability also is 25,000 as on this date. Yes, sir. Then on 30th June 2001, liability decreases, so it become gain. So what journal entry will do? Derivative financial liability account debit to fair value loss, transfer to PL, How much loss? Loss is 10,000. You can see you have decreased your liability by 10,000. So now your liability as on this date will become 15,000 automatically. Correct. Then next interim reporting date is what? 30th September 2001. So now liability will decrease and asset will increase. So we need to de-recognize liability. So journal entry is derivative financial liability, account debit. How much? 15,000 will decrease. And we need to recognize what? Asset will say derivative financial asset, account debit. How much asset? It is 12,000. So there is a gain of how much? 2 fair value gain. Fair value gain transfer to PL. How much? It is, you can see 27,000 gain. So that's why I have said whenever negative become positive, we need to add it. Understood now? 27,000. Correct. Normally student do mistake here only. They have understood, but in exam पता नहीं क्या होता है. Correct now. They are confused with the information given in the question. But you can see simple question now. Now on 31st 12 2001. Once again asset become liability. So we need to now de-recognize asset and recognize liability of rupees 40,000. So there is a gain. We'll say fair value gain transfer to PL, and I think gain is 52,000. But we need de-recognize what? Asset. So we'll say to derivative financial asset. How much? It is 12,000. De-recognize. I will recognize what? Derivative financial liability. How much? It is 40,000. So now there is an obligation to pay 40,000 on settlement date. Correct. Now on settlement date, there can be two situations. Either it can be physical purchase of dollar, or it can that entire contract can be settled net in cash. If question is silent, normally we do settlement net in cash, but in this question it is given actual purchase of dollar. Correct now. So I'm just passing both the journal entry. Suppose now we are doing settlement journal entry. We call it settlement accounting. So if settled by actual purchase of dollar, means in exam you do this journal entry only because they have specified in the question it is settled by actual purchase. Means you will purchase dollar, so your dollar will increase. So of course dollar means your currency will increase. It is bank account only. But you will say dollar. How much dollar will come? $20,000 will come, and today the value is what? 66. So it will be recognized at current fair value. So 20,000 into 66, how much? 13 lakh 20,000. But you will purchase dollar and you will pay rupees. So you will say to bank, your rupees will increase and your rupees will decrease, and you will pay as per the contract. You will pay at 68, so your outflow will be 68. Understood now? That is 20,000 into 68, how much? 13 lakh 60,000. And you can see the difference is nothing but 40,000, which is nothing but liability you have already recognized. So that liability will be now automatically cancelled. So you will say derivative financial liability, account debit. How much? 40,000. So this derivative accounting will be now over. Understood? Understood what I am saying? Thank you, Amar. Thank you, Naveen. I hope you all are understanding. Please bring CFS chapter. Of course, the next topic will be CFS only. Don't worry. So I'll come soon with CFS expected questions. Correct. Then point number B, write down. Or if question says if settled net in cash, correct, then simply there is an obligation to pay 40,000 in this contract. We'll pay 40,000 to what journal entry? Derivative financial liability, account debit, 40,000 to bank. Simple one journal entry will do. Got it? Have we understood these two cases? But in this question it is already given this, so don't pass this journal entry in exam. Got it? Yes, sir. Have you understood this? Bol. Simple. So this question also done. Yes, sir. Next. Now let us come to the one more question. Then already we have done in the last video. Come to this question 11. This is also a question of embedded derivative. Embedded derivative. What is this question? Let me explain from this question only what they have said. Company A, an Indian company whose functional currency is rupees, enter into a contract to purchase a machinery from unrelated local supplier, Company B. The functional currency of Company B is also rupees. However, the contract is denominated in dollar since the machinery is sourced by Company B from a US based supplier. Payment is due to Company B on delivery of machinery. Key terms of the contract. Contract date 9 September. Delivery date 31st December. Purchase price US dollar 10 lakh. US dollar means forward rate they have given. Forward rate on 9 September means on contract date 67.8. Then spot rate on 9 September is 66.4. Then forward rate on 31st December, correct? Forward rate for 31st December, correct? Understood? On 30th September means they are saying 30th September maybe what one interim reporting date. So on that it is 67.5 and on 31st December spot rate is 67.0. Company A is required to analyze if the contract for purchase of machinery, a capital asset from Company B, contain an embedded derivative and whether this should be separately accounted for on the basis of guidance given under Ind AS 109. Also necessary journal entry for accounting the same. Now whenever these type of questions come, it means there is an embedded derivative. Just try to understand what actually happened. There is one Company A and Company B. Company A and Company B, functional currency is what? Functional currency is rupees. But they have done one contract to buy a machinery at 10 lakh dollar now. Now the question is that if both companies functional currency rupees, why they are entering a transaction in dollar? It means there is something embedded in this contract. Means in this question what they are saying, host contract is what? Purchase of machinery at rupees only. Means normally this transaction is done at rupees. Because both companies functional currency rupees. Yes, if suppose the case is that functional currency rupees and dollar, so of course this transaction can be entered in dollar. But because the functional currency rupees, now the question arises, what is the motto, what is the objective of entering this contract? What is the objective to enter this contract to settle at dollar? Means they want to earn some speculative income with the changes in the price of dollar. Correct? Now they have asked from A's point of view or B's point of view, that we need to understand. So company A means they have asked from A's point of view, so we need to answer from A's point of view. Correct? Now are you able to understand? So what this says, in this there is one host contract is what? To buy machinery at rupees only. But how much rupees? Rupees will be 10 lakh dollar multiplied by forward rate, because as on the contract date we don't know what will be the spot rate in future. It means we need to estimate the forward rate, and they have given forward rate how much? Forward rate is what? Forward rate on 9 September is 67.8, so it will be 67.8. Correct? Now it will be 10 lakh into 67.8 means it becomes 678 lakhs. It becomes 678 lakhs. Have you understood this point? This is the host contract, and in this there will be one embedded derivative. Embedded derivative Correct. Now just try to understand in this contract A will pay dollar or A will receive dollar. So of course A will pay dollar, means they are receiving machinery and they are paying what? They are receiving machinery and they are paying dollar. It means when they are saying receiving machinery, they are purchasing machinery, and when they are paying, they are paying dollar, means they are selling dollar. They are selling dollar now. It means there is another contract which is embedded in this host contract. So what is the embedded derivative? Is to sell. Is to sell means pay now. When I am saying buy means receive. Correct. So to receive machinery and to pay dollar, it means to buy machinery and to sell dollar. Correct now. To sell, can I say 10 lakh dollar? 10 lakh dollar. Add forward rate only. So add 67.8. Add 67.8. This is the two contract. I hope you have understood. Now we need to pass journal entry for this. Have you understood why this there is an embedded derivative? Because they want to earn with the changes in the price of what dollar also, means they want to earn some speculative income. So what Ind AS 109 says that whenever a derivative is embedded in host contract, we should separate it. We should separate it. Understood? Correct? Now, if I try to explain now the derivative points. So what is the contract date? 9 September. Then this is 30th September. And then they have given 31st 12. So they have given 3 dates. 9 September, 9 September 2001. 9 September 2001. Then 2001. This is also 2001. So they have given spot rate and forward rate on this date. So forward rate is 67.8 na. Forward rate is 67.8. 67.8. Correct. And spot rate as on this date is how much? Can you help me? You can't help me. Sorry. A minute. When I was writing, give me 1 minute. Yeah, correct. So can I say forward rate? Forward rate is 67.8. Correct. Spot rate is given how much? Spot rate is given 66.40. This is 66.40. Then on this date, they have given forward rate how much? 67.5. 67.5. And on 31st December, they have given spot rate how much? 67. These are the information given. Correct now. So normally, we don't require this information. We don't require the information spot rate whenever we have entered into forward exchange contract. I mean, this information is bakwas. And can you see on settlement date, both will be same forward rate and spot rate will be always same, because now there is no forward contract. So on settlement date, forward rate will only become spot rate. Correct now. So normally we require this information. We require this information. Understood? Now we have entered into sell what? To sell dollar at what? 67.8. So we need to find out what is the fair value. So what is the fair value of forward contract? Initially it is nil. Initially it is nil. Understood? Initially it is nil. Now you can see you have entered into a contract to sell dollar. Why you have entered into a contract to sell dollar? Because your expectation is that dollar rate may fall. So your expectation is that dollar rate may fall. Correct now. This was your expectation. Now what happened? 67.8 becomes 67.5. Means even the dollar rate is 67.5, you can sell at 67.8. So there is a favorable situation. there is a favorable situation. So what is the fair value? Fair value becomes 67.5 minus 67.8 is equal to what? 0.3 into 10 lakh. This become fair value of forward contract. I hope you are understanding. Have you understood this point? So it become how much? 3 lakh. 3 lakh is what? Asset. Why it is asset? Because it is a favorable situation. It is a favorable situation. So you can see I have compared these two. I have compared these two. So whenever you are calculating fair value, always compare current forward rate with the opening forward rate. With the opening forward rate. Understood? Yes, sir. So you can see because there is an intention to sell dollar. So if the price decreases, so it is favorable only because you can sell at about 67.8 even though the price becomes 67.5. But on settlement date it becomes 67. On settlement date it becomes 67. Again fall, so it become again what? Favorable. This is also favorable situation. So now once again you will compare these. So difference is what? 0.8. So fair value become what? 0.8 into what? 10 lakh. The fair value become 8 lakh. Understood? Have you understood this point? It means it now the same question become to this question becomes similar to previous question in relation to derivative. So you can see there is a gain because it is an asset. There is a gain of what? 3 lakh. Then there is a gain of what? 5 lakh. I hope you are understanding. Gain of 5 lakh. Now we can do the journal entries. Can you do the journal entries? Yes, sir. So first, for entering into the contract, when the contract was entered on 9 September, on 9 September 2000. Can you say for entering into contract, because no consideration has been paid for entering into the contract. Actually, till now we have not purchased the machinery, so no journal entry. No journal entry. Correct. Then on 30th September, can you see we need to recognize one derivative asset? Correct. Because there is an asset of about 3 lakh, so we'll pass one journal entry. Derivative, financial asset, account debit to fair value gain, and this fair value gain will be transferred to PL. That is 3 lakh. Understood? This journal entry, have you understood? Correct. Then we'll come to settlement date on 31st 12 2001. Correct. Once again there is a gain and your asset become now 8 lakh, means increase the asset by 5 lakh. So derivative financial asset, you need to increase the asset by rupees 5 lakh, and there is a gain of what? 5 lakh to fair value gain, transfer to PL 5 lakh. Got it na? Bol. Correct. Now we'll come to actual purchase of machinery. So now we'll purchase machinery. So journal entry what? Property, plant and equipment, account debit to bank. To bank, or we'll not say to bank, we'll say payable. Initially we call it payable. Chalega? Payable. Are you able to understand? So can I say there was an intention, means what was the intention? There was an intention to purchase machinery at forward rate. At forward rate, now what was the host contract? To purchase it was 67.8, means 678 lakhs. So we'll say 678 lakhs. This will be 678 lakhs. 678 lakhs, correct now? Because there was intention to purchase at 678 lakhs only. I'm writing 678 lakhs. Chalega? You write them full amount. Now 678 lakhs. Any doubt? Now there is a derivative financial asset. And can I say because this contract has been done with the company B, so there is some amount receivable from company B in the way of derivative asset. So can I say this amount is payable and this amount is receivable? So we'll net off. So what we'll do? We'll pass one journal entry. Payable will now decrease. Payable will decrease by 8 lakh to derivative financial asset. How much? 8 lakh means ultimately how much we are paying? We are paying 670 lakhs only, and the spot rate you can see is 67 only. So ultimately we are paying as per spot rate, but what we are doing, we are trying to identify how much there was fair value gain or loss because of embedded derivative. Correct now. So actually we are paying 670 lakh only. Means what generate next journal entry? Payable account debit to bank. Payable account debit to bank. How much? 670 lakhs. 670 lakhs. Understood. But you can see machinery was recognized as 678, and there was a derivative financial asset of what? 8 lakhs. If you have not done this accounting, to what journal entry you would have done? Machinery account debit to 670 to bank. That was not correct journal entry. So what Ind AS 109 says that if there is some embedded derivative, that should be recognized at FBTPL, and if fair value gain or loss should be transferred to PL. Have you understood? Got it? Bolo. Journal entry is okay? Any doubt? No doubt? Chalo. Yes, sir. Now let us come to the next question. Come to the next question. Hello. Now there is one question I have taken for cash flow hedge. This is newly inserted question. There is a high chance this question may come in exam. Correct. Let us do. Beside construction activity, Building and Company Limited is also engaged in trading of copper. On 1st April 2001, it had 100 kg of copper costing rupees 70 per kg, totaling rupees 7,000. The company has a scheduled delivery of these 100 kg of copper to its customer on 30th September 2001 at a rate of US dollar on that date. So just try to understand. They have said scheduled delivery, but it means there is an expectation, there is an expected sale of this copper. So whenever there is an expectation that will purchase and will sell in future, so it become highly probable forecasted transaction. Whenever there is a highly probable forecasted transaction, so there is risk of what? There is a risk of either decreasing cash inflow, or increasing cash outflow. So in case of expected sale, there is a risk of what? Decreasing cash inflow. Therefore, we will try to hedge such type of expected transactions, and that type of hedging is known as cash flow hedge. Understood? Yes, sir. To protect itself from a decline in the currency exchange rate, because there is a expected cash inflow, na? So there is a risk that there may be some decline in currency exchange rate from US dollar to rupees. The entity hedges position by entering into currency future contract for equivalent currency units at rupees 76 per US dollar. The future contract matured on 30th September 2001. The management performed an assessment of hedge effectiveness and concluded that hedging relationship qualify for cash flow hedge accounting. It is given also. The entity determined that and document that changes in fair value of currency future contract will be highly effective in offsetting the variability in cash flow currency exchange. So what Ind AS 109 says that whenever cash flow hedge is effective, then we'll transfer any fair value gain or loss of that derivative contract in OCI, and it will be accumulated in cash flow hedge reserve. But if it is ineffective, the entire gain or loss will be transferred to PL. This is given under Ind AS 109. So if it is effective, then we need to open one cash flow hedge reserve account. Correct. On 30th September 2001, the entity closes out the currency future contract. On the same day, it also sells the inventory of copper at US dollar 100 when the spot rate on that date is 72 per US dollar. You are required to prepare detailed working and pass necessary journal entry for sale of copper and corresponding hedge instrument taken by the company. Pass the journal entry as on initial date 1st April 2001, first quarter end reporting 30th June 2001, and date of sale of copper and settlement of forward contract on 30th September 2001. Assume that exchange rate as follow, and the yield rate is 6% per annum. Now in this question they have given yield rate, means they have given discount rate. So when we are calculating fair value of forward contract, in all the previous question we have not done discounting because discount rate was not given, but in this question discount rate is given. So we'll find out a fair value of forward contract, fair value of forward contract by using the discount rate. Understood? Yes sir. You can see the date is given. You can see initially the forward rate was 76, then it becomes 74, then it becomes 71. This is the information. So let me first explain you. What is the question? We are doing question number 12. So the contract date, then reporting date, then settlement date. Contract date was on 1/4/2001, then it become 30th June 2001, then it become 30th September 2001. Correct? Understood? Now the cost price of copper was how much? It was 100 kg into 70, that was 7,000. Understood? And they want to sell, expected sale, they want to sell what? 100 kg into 100 kg at 100 US dollar. Means the total price was what? 100 US dollar. This was rupees. Correct? 100 US dollar. This was expected sale of copper. It means there is an expectation that $100 will receive on this date, and because there is a expectation that dollar rate may decline, therefore they have entered into correct forward contract to sell dollar at what? At 76 forward rate. Now the forward rate becomes 74, then it becomes 71. This is the forward rate. Spot rate it is given, it is not required, but here it is given 72. Normally this rate will be same, means spot rate on settlement date and forward rate on settlement date will be same, but I don't know why they have given different rate. So we'll go as per the information given in the question. We'll not try to change the information as per our concept. Okay, correct. But can I say in this there are two type of contract. One is we need to sell what? Inventory on this date, and we have entered into forward contract. So we need to find out fair value of forward contract. So initially it was nil. Then you can see 76 becomes 74. So 76 becomes 74. Correct na? 76 becomes 74. Yes. So it is favorable or unfavorable situation. First we need to find out that favorable or unfavorable situation. You only say is a favorable situation because we have entered into forward contract to sell what? Dollar at 76. Now it becomes 74. Then also we can sell at 76. So favorable situation. You can see 2 into 100. It become what? 200 fair value. And then once again it becomes 71. So once again it is favorable. It is 2 into 5. 200 into 5. Correct now? It is what I have done. Yeah, sorry. 5. So it is 5 into what? 100. That is 500. 500. Yes, sir. So this become what? Fair value. This become fair value. Means can I say just try to understand what I am saying. Just try to understand whatever I am saying. Correct. Everyone. Just whatever I am saying. Means can I say in this way? On this date, this is the fair value of forward contract. Means this amount is receivable after how many months? This amount is receivable after how many months? 6 months. Correct? Because this is forward rate, means the actual sale will be done after 6 months. Now, if the fair value is nil as on this date, so this amount is receivable after 6 months. Okay, this amount is receivable after what? 3 months. And this amount is receivable on the same day means 0 month. I hope you are understanding. So if you are doing discounting, so this discounting is for 0 month, this is for 3 month, this is for 6 month. The rate of interest they have given 6% per annum. Per annum it is 6% per annum. So 6 divided by 4, it will become 1.5% per quarter. Per quarter. Now we can find out fair value. So let us do calculation. Calculation of fair value of forward contract. Correct. So on 1st April 2001, on 30th June, and on 30th September. Correct. So fair value already we calculated, means value without discounting already we calculated. 0, it is 200, it is 300. Now we'll multiply by discounting factor. The discounting factor 1 point, this is 1.0, it will be 1.015, correct? Divide equal to, so this will be 1, discounting factor will be 1, this will be 0.985, and this will be 0.971. Have you understood this? Normally you will do mistake this here only, because this amount is payable after 6 months. After 6 months, because quarterly, so you take discounting factor for 2 term. This is discounting factor for 1 term. This is discounting factor at the beginning. At the beginning means 1 only. So 1985. If you have understood this, so you can easily calculate the amount. This is 500, sorry. You can now easily calculate the fair value. So what is now fair value? After discounting, this is 0. This is 200 into 0.985, that is equal to what? 197, and this becomes 500. So what is the fair value gain or loss? Fair value gain or loss, because fair value is increasing, therefore it is a gain. So initially it is 0, it is 197, and this difference is how much? 303. This become gain. Understood? This calculation, if you have understood this question, is very easy. Now if you have understood this, can I proceed? Follow. Have you understood this much? Bol. Have you understood this much? Yes, sir. So now what will be the accounting treatment? So can you say on 4/2001, no entry because fair value is 0. Then on 30th June, what journal entry? There is a gain. There is a derivative financial asset. So we'll say derivative financial asset. Or you can say, you can also call it what? You can also call it what? In it. You can also call it future contract or financial asset, whatever. Correct now. So you can say derivative financial asset account debit to fair value gain, and this fair value gain will be now transferred to OCI and accumulated in cash flow as reserve. Correct now. So it will not be transferred to PL, it will be transferred to OCI. Why it will be transferred to OCI? Because on actual sale, means when you will do actual sale, then only can I say the gain or loss will arise. So right now, on expectation sale of copper, because that transaction is not yet done, therefore it will be accumulated in a separate component equity. So better you can write down this way, to OCI, otherwise you need to find the past 2 journal entry, and it will be accumulated in cash flow as reserve. You can add down cash flow as reserve. In exam, write down full cash flow as reserve. Correct? So OCI cash flow as reserve. Chalega? You can write down this way, 2 OCI cash flow as reserve or 2 cash flow as reserve OCI. Both are correct. This is 197. 197. Then again on which date? This was 30th June, then 30th September. Once again, the same journal entry, derivative financial asset account debit to OCI cash flow has reserve. It will become 303. So you can see your financial asset become 500. Your financial asset will become 500. Got it? Yes, sir. Now on the same date, now what we'll do, we'll sell the inventory. We'll sell the inventory. So if we'll sell the inventory, what journal entry will do, it will be what, the journal entry will what, bank account debit to revenue. So can we do that? So journal entry will what, bank account debit to revenue. Chalega. So bank account, or you can say trade receivable or receivable, because we don't know whether that amount is received or not received. So bank account debit to revenue. Bank account debit to a revenue. How much? 7. It was sold when the spot rate was 70. When the spot rate was how much? 72 na? When the spot rate was how much? 72. So it will become 7,200. 7,200. Got it? Yes, sir. So this journal entry we are doing as per Ind AS 21. This journal entry we are doing as per Ind AS 21. Correct? Are we able to understand? Are we able to understand? Now, of course, if you want to pass one more journal entry, because inventory will be now recognized as cost of sale as per Ind AS 2, you can pass one more journal entry, but that entry is not given in the solution. Cost of sales to inventory. This is as per what? Ind AS 2, inventory. And the cost price of inventory was given in the question 7,000. 7,000. This journal entry we are doing as per Ind AS 2. Correct. Are you getting? And this journal entry we have done as per 109. As per 109 hedge accounting. Correct. Now what 109 says that? Correct. Now if this cash flow hedge, this hedging contract result in a non-financial asset. Result in a non-financial asset. You can see in this though, of course, it will result in a financial asset. It is not resulting in non-financial asset. If it is non-financial asset, so this will be this entire gain or loss which has been accumulated in cash flow has reserve. Cash flow has reserve account will be adjusted. Cash flow has reserve account will be adjusted with that non-financial asset, means carrying amount of non-financial asset. But because in this question it is not resulting in what? Non-financial asset, so it will be reclassified to PL. So entire accumulated gain or loss will be reclassified to PL. So two journal entry we do. First, so can I say we will realize derivative asset. So journal entry what? Bank account debit to derivative financial asset. How much? 500. This much will be realized. This will be realized. And second journal entry will say OCI cash flow has reserve, and this will be reclassified from OCI to PL. OCI to PL, so you can adjust with the revenue only. We can say revenue will be transferred to PL only. This is 500. These two journal entry will need to do as per hedge accounting. Understood? So as per 109. Have you understood this point? If you have understood this, so you can easily do an exam. Have you understood this point? Bol. I hope, sorry, I hope you are understanding. So with this question is also completed. Got it? Only one question is left. I will take that question also. Let me take that question. This 13th we have done. 13 we have done. Two questions are left. Let me take first 14. This is very much expected because similar question was given in last attempt RTP not yet asked. So very important question can be asked. Okay. So you need to do this question. Very important question. Previously I don't used to say expected. Now it become expected because it was given in last RTP not yet asked. Correct. Yes, sir. On 1st Jan 1999, entity issued 10% convertible debenture with a face value of 1000 maturing on 31st December 2008. The debenture is convertible into equity shares of entity A at a conversion price of 25 per share. When I am saying 25 per share, it will be 1000 divided by 25 is equal to how many equity shares? 40 equity shares? Yes, sir. Interest is payable half yearly in cash As a date of issue, entity could have issued non-convertible debt with a 10-year term bearing coupon interest rate of 11%. Means from the first para it is understood it is a question of what? Compound financial instrument, and if it is a question of compound financial instrument, you can split it. Splitting you can do. Means I am not explaining splitting, and they have not asked splitting in this question. Splitting you can do. But what happened on 1st Jan 2006? 1st Jan 2006 means 99, 2000, 2001, 2002, 2003, 2004, 2005 means after 6 years they are saying. To induce the holder to convert the convertible debenture promptly, entity A reduces the conversion price to 20 if the debenture is converted before 1st March 2006, that is within 60 days. Now can I say there is some changes in the terms of the contract, means amendment in the terms of the contract. So now the conversion price become from 25 to 20. So you can see now if the 20 it become, so what will be number of equity shares divide by 20, it will become how much? 1000 divided by 20 means 50. So what is the additional equity shares we will be offering? So additional equity shares will be 10 equity shares. Understood? How will, what they are saying, the market price of entities A equity shares on the date of terms of amendment is 40, means this become 10 equity share into 40, so this become the 400 additional, this become the fair value of equity shares. Amend means fair value of increased number of equity shares, that is 400. How will the revised terms be accounted? So as per Ind AS 109, if there is some amendment in terms, by giving some additional equity share, the fair value of equity share will be transferred to PL. Means this will be recognized in PL. So this 400 will be transferred to PL. You can see same is calculated and this will be transferred to PL. Means the value, what do you need to say, that this value of incremental equity shares issued upon conversion will be recognized in PL. Only this is the answer. How to calculate? I hope you have understood. How to calculate? I hope you have understood. So this whatever has been amended, that will be means how much you are issuing additional number of equity shares, that will be transferred to PL. Will be transferred to PL, not to equity. Not to equity. Got it? Have you understood? How it is calculated already I have said. 1000 divided by 20, it is 50. 1000 divided by 25, 40. So additional become 10 equity share. The market price on as on that is 40, it become 100. Got it? Yes sir. Very easy but very important question. Very important question. Can be asked in exam. One more question I have left that I will do. What question was that? Question 4. Now this is a question of impairment can be asked. Impairment question can be asked. Last attempt they have already asked one impairment question. So I don't know whether it will be asked or not. But from my point of view, if they ask from impairment, they can ask this question now. An entity purchased a debt instrument with a fair value of 1015 March 2001 and measure the debt instrument at FBTOCI. Correct? So first journal entry will be financial asset account debit to bank. You can see financial asset account debit to bank 1000 they have done. Correct? Yes sir. Yes sir. The instrument has an interest rate of 5% over the contractual term of 10 years and has a 5% effective rate of interest. Can you see whenever contractual rate of interest and effective rate of interest will be same, then amortized cost will be equal to initial fair value, because can I say your interest expense and contractual cash inflow both will be same. Correct? Yes sir. At initial recognition, the entity determined that asset is not purchased or original credit impaired asset. This point is not important, ignore it. On 31st March 2001, the reporting date, the fair value of debt instrument has decreased to 950 as a result of changes in the market interest rate. So now the fair value become 950. Correct now. So of course can I say carrying amount was 1000. Why the carrying amount is 1000? Because can I say once again I have said, because both are same, contractual rate of interest and what? And ER are same. So therefore the initial fair value will be only the closing balance. So first we will find out carrying amount and then compare with what? Fair value, and you can see there is a loss of 50. This loss of 50 will be recognized in OCI because it is what? A financial asset measured FBT OCI. Correct? So we will pass one journal entry OCI account debit to OCI account debit to what? Financial asset, correct? The entity determined that this has not been a significant increase in credit risk since initial recognition, and the ECL should be measured at an amount equal to 12 months, which amount to 30. Now out of that 50, what they are saying, there is a expected credit loss of 30. So whatever loss, impairment loss will be transferred to PL. So can I say we can pass one journal entry, impairment loss account debit to OCI, means we need to, what journal entry? Let me explain you with the writing, but then only you will understand. Let me explain you. Then only you will understand. We are doing question number 4. Question number 4. What is the date? The first date is 15th March 2001. First journal entry you have done financial asset, account debit to bank. How much? 1000. Now in this question they have asked you to ignore interest, but let us pass journal entry for interest also. So on 31st March 2001, can I say first we recognize interest income. So journal entry will be financial asset, account debit to interest income. Interest income. This is calculated by applying EIR. So we'll say 1000 into 5% for 15 days. It will be 15 by 365, correct? So 1000 into 5% into 15 divided by 365. It is coming 2.05. 2.05, correct now? Yes sir. Because the amount is very less, therefore they have asked you to ignore it. But what I want to explain that, now you receive also whatever amount you receive, that is also based on 5% only, correct now? So we will do bank account debit to financial asset, and that will be also 1000, but this amount whatever you are receiving, that is based on contractual rate of interest, but the amount will be same only, 1000 into 5% into 15 by 365, and same amount you receive, that is 2.05, because this is same, therefore can I say the closing balance of this asset, after this journal entry will be 1000 only. Now on this date you need to measure at fair value. Now what is the fair value has been given? Fair value has been given 950. What I was explaining, that carrying amount is 1000. Why it is 1000? Have you understood? Because it will be measured, amortized, means it is what? FBTOC here. The first you need to find out this carrying amount, na? So this carrying amount is this plus this minus this only. I hope now you are able to understand. Suppose this EIR was different, then contractual rate of interest, then this carrying amount will change. Understood? So now there is a loss. Of what? 50. So first you will pass what journal entry? OCI accumulated in a separate component of equity. So we can say FBOCI reserve, account debit to financial asset. How much? 50. But what happened now? They have given some impairment loss. So out of 50, there is an impairment loss which is calculated as per Ind AS 109 by applying ECL and 12-month ECL or lifetime ECL. That I am not discussing. But out of 50, there is an impairment loss over 30. So this impairment loss will be transferred to PL now. Will be transferred from PL, and we will say impairment loss to OCI. Means we will do adjustment in FBOCI reserve only. So this journal entry will do 30. In your solution they have compounded these two journal entry. Means what journal entry they have done? They have done OCI FBOCI reserve 20. Then impairment loss transfer to what? PL 30. They have done this journal entry. But we can do this two journal entry, or we can do this one compound journal entry, your choice. Have you understood these two journal entries, this two way of journal entry, correct? But effect remains same. Now what they have given? On 1st April The entity decided to sell the debt instrument for rupees 950, which is its fair value. Now sale has been done. So on next day, on 1st Jan next year, we'll pass journal entry bank account debit to financial asset, that is 950, and there is no gain or loss because carrying amount was 950 and the financial asset was sold at 950. But can I say once it is de-recognized, all accumulated gain or loss will be recycled to PL, means one more journal entry will do. What journal entry will do? PL account debit to OCI FB OCI reserve. Correct. Now it will be reclassified to PL. We reclassified 20. Whatever was accumulated in FBOC reserve will be reclassified from OCI to PL. That journal entry. So this is the next year journal entry. Understood. This is also expected from my point of view if they are asking question on impairment. With this, I have completed all the question which is expected from my point of view for this particular chapter, financial instrument chapter. And I hope you have understood all the questions now. Now any question if you are finding difficulty, that you comment in the comment box. I will make a separate video for that particular questions. Chalega? Correct. So for today this much only. In the next video or next live session will come with the another chapter, that is what? Consolidated financial statement. So next video next day will come with what? Consolidated financial statement chapter. Chalega? Thank you very much for today. We'll meet in the next video. Till then, bye bye. Take care. Enjoy your day. Enjoy your preparation. Bye bye. Love you all. Bye bye.